Now let's take a look at the bigger picture. Matthew Johnson's with us, president owner Johnson Wealth and Income Management. Good to see you. So what did you think of the Fed's move right yesterday, which was no move, or double pause, back-to-back pauses? We got what we expected, but anything from the language that you were able to read through?
I think right now everyone's feeling the same thing, right? Everybody's just wiping their brows saying, boy, glad we dodged that bullet. The reality is that the Federal Reserve is going to continue to stream. They're going to keep that extreme, vague language. They want to be able to keep a little bit of a psychological lid on the economy. They don't want expectation of the rate cuts right away. They're wanting to try to keep everything quite muted. And I think it was pretty interesting because when we saw some of the data coming out last week, you know, when we see a pretty strong GDP number, when we see unemployment numbers down a little bit more than expected, I think that there was a lot of economists that were really expecting, you know what, maybe the Feds will go ahead and pull the trigger on another 25 basis point increase. But we are all very, very relieved that they didn't. Now, I think that the big question, Nicole, comes, what are they going to do for the rest of the year? And does this mean that they're actually halting? I think it's going to be over when it's over, and it's going to be over when they say that it's over. So I think we all have to continue to exercise that vigilance in being very, very careful to not make expectations the norm. I think we have to continue to rely upon what the Feds are doing and the data and how they're interpreting that data that comes to them.
Right, understood. So you still think that you're not comfortable to say this is the end of the rate hike cycle because of things like the strong GDP and unemployment coming down, and so we'll have to wait and see. That being said, what do you think about what's been happening with bond yields, and where do you see those headed?
Well, the bond yield market, if you're a bond buyer, I can definitely tell you that what's really hurting is the portfolio of the bonds that you have owned in the past. But what you were very much looking for is the deeply discounted prices within the bond market right now. We don't even have to look at the bond market, really, Nicole. If we take something just as simple as the preferred equity market, and you look at that, look at those are contractual, just like a bond is. They've got a par value, just like a bond does. And what we want to do is we want to be able to value invest. There's a lot of good, strong companies out there that have good quality bonds, and many investors have bailed. And it's our responsibility to do our due diligence, but look at the yield that you're getting now on the bonds if you can afford to buy them. And not only that, but look at what would happen if you're able to purchase shorter durations and you got bonds that are going to be maturing in, say, 2 years, 3 years, 4 years, or 5 years, and they're returning to you an exponential 15% capital gain, maybe 20 or 25. So we cannot discount that, and that exact same thing is also happening in the preferred market as well.
You know, would you say, we talk about monetary policy so much, do you think fiscal policy and monetary, they're supposed to work together? Do you see that happening or not necessarily right now?
I think right now there is a major amount of disconnect that is actually happening. Right. I was watching an interview or a press conference that was taking place back in Reagan's era, and he was talking about, you know, when unions and so many different factors, they increase the wages, it ends up being a tax on the actual individual. And we see, thank goodness, that all of the strikes are done with the UAW. But I can't help but think, you know, that's going to cost automotive manufacturers more money. And I get why they're doing it. I get it. I understand it. But ultimately, where's that additional cost going to come from if it doesn't force the value of the automobile and the price of purchasing that automobile up? And so we have to be very careful to understand right now what's happening in Washington versus what's happening in the economy versus what's happening in the average, you know, home today. There is an awful lot of disconnect between all three of those areas. And I'm very concerned for the average family, where I'm seeing so many more individuals that just aren't making it, and they're having to rely upon, say, things like credit card debt just to pay the bills, hoping, just praying that in 2024 we see those rates come back down.
Right, understood. And then last but not least, we talked a little bit about investing, and you said those who have had old bonds, maybe not so great, but what would you advise to folks now if they're investors? whether it's stocks and bonds? I mean, we haven't talked much about the equity market. What would you advise folks?
Well, I think in many respects, the market is probably going to remain. You're going to see rallies like this. You're going to see some optimism that leaches into the market, and you're going to see that you have some really good days. And today's one of those days. We should be celebrating the fact that the Feds didn't raise the interest rates again. But at the same time, all throughout 2023, I've encouraged all of your listeners and your viewers, as well as my own clients, that we want to continue to reinvest. We want to continue to dollar cost average into this market. It's very, very difficult to be able to time the market and know when to get in and when to get out. But if we have a good, solid basis of dividends and interest that are flowing into our portfolio, now we have the opportunity to every single month reinvest those interest and dividends, whether it be in the bond market, whether it be in the equity market. Right now, there's a lot of good quality equities, Nicole, that are pushing almost 5% in dividends. Think about that. That's a bond-like yield, but it's still an asset that has some appreciable characteristics. And I think we don't want to play small. We want to be able to be buying right now because, let's face it, we don't know what the future holds. We don't know what the Feds are going to do. Yes, things could go break loose and decline, but we want to be looking optimistically down the road and being able to buy some good quality things today so as to help our future become more successful tomorrow.
All right. Thank you for all of that. Great to see you. Really appreciate it.
Thank you.
Matthew Johnson, Johnson Wealth and Income Management.